Ticker symbol MCHP has returned over 8% in the past year, and this is without considering dividends. But today, we'll be looking at an attractive, high dividend growth company and why it was ranked a 9 outperform by TipRanks, based on a moderate buy from analyst consensus, but decreased hedge fund trends and net insider transactions of selling shares. So let's talk about Microchip Technology, a technology provider. In their annual report, they say that they develop, manufacture, and sell connected and secure embedded control solutions used by their customers for a variety of applications. So basically, they sell total system solutions, or TSS, which is either hardware, either software, or other services, which will help their customers increase their revenues, reduce their costs, and manage risks. Just to give a bit of context, hardware is what you're seeing in the image, is things that you can touch. Software is what runs inside your computers, like the programs, the applications, and all of that. And then services will be like ideas, implementation products, and stuff like that. They say that their product portfolio empowers disruptive growth trends, meaning that thanks to their hardware, software, and services, they can help companies acquire and develop their own 5G, data centers, sustainability, Internet of Things, and even autonomous driving. So the main markets that they actually serve is, first of all, automotive, then aerospace and defense, communications, consumer appliances, and data centers and computing. But this company gets really interesting when we look at the financial analysis, as it has a return on capital employed of 19%, an interest coverage ratio of 15 times, cash conversion of 116%, which is really solid, and this number basically means how good this company is at turning their net income into free cash flow. Then they have very healthy profit margins of 60% and an operating margin of 37%, which is excellent. Just for you to know, the threshold that we usually look for operating margin is anything above 15%, so this 37% is best in class. Their revenues, gross profit, and net income had been growing every single quarter until last quarter, where revenues actually dipped a little bit, and since the gross margin and net margin stayed very consistent, the gross profit and the net income also dropped a little bit. However, since in the 4 past years, the gross margin has been extremely stable, but the net margin has increased from under 15% just close to 30%, something spectacular. And although this company likes to leverage their operations in order to grow at a faster rate, you can see that in the past they have been deleveraging to get both their current ratio and debt to equity levels to a very healthy ratio, which is where they are right now. As you can see on the graph to the right, they used to have a lot more debt than equity, and there has been a clear trend of reducing that and getting the debt to equity to a more sustainable level, which they have achieved. And their efficiency ratios have been booming thanks to the growth of this company, with return on invested capital sitting comfortably at 35%, which is something that not a lot of companies can actually brag about. This company gets a solid 7 out of 8 ticks when conducting the fundamental analysis, and starting with the fact that they have low liability risk. This was seen with the interest coverage ratio that we defined in the first slide. Then they provide extremely consistent cash flows thanks to the clear growth that we saw in the revenue and net income. Next, they pay out a dividend, a very consistent one that is growing, and then they also conduct share buybacks, which gives the double effect of returning free cash flow to the investor, and it's something that we really like on solid, stable companies. Then this company, of course, has pricing power, as they're able to develop solutions for our customers and charge a variable fee based on whatever impact they have on the company. And this is very powerful because if you do your job well, you actually get a lot of return for the customer, and you actually had a variable fee over there. The payment tends to be a lot higher than if you have a fixed fee. Additionally, they also have pricing power with fixed fees because they are providing a very specific service which they have the know-how for. Then their free cash flows are growing organically, which are being funneled by their organic growth in revenue. And finally, they do have an existing moat and a very big competitive advantage, since in this industry, the majority of the customers that they have are actually recurring customers. And I believe that this is one of the best competitive advantages you can have, because it means that as long as you do your job well with your customers, they will keep coming back to you for more help or to hire you for more services. Additionally, as stated previously, since this company already has the know-how and the technological expertise, whatever they do, they will be able to do it cheaper and at a higher margin than any other competitor that will enter the space. So that, to me, is the definition of a moat. And when we look at their dividend growth, you can see that up until August 19th, 2021, the dividend was extremely stable and it didn't move a lot. but since then, the dividend has grown massively. The dividend right now sits at a dividend yield of 1.91%, paying 1.7 in dividends per share at a very healthy payout ratio of lower than 40%. And one extremely good thing to note is that you can see that the green line, the amount paid, is rising at a way much slower pace than the dividend per share, the blue line. Why is this? Well, this is a clear indicator of that the company is consistently buying back their shares, because even if the amount paid doesn't increase that much, the dividend per share increases a lot more, meaning that there have to be lower shares. This company has extremely high growth potential. They could go the geographical expansion way and go into different countries, into different economies, and try to grow their offerings over there. And the second one is that they could develop new offerings for their current customers and cross-sell them with the new offerings. For example, if you have a customer which you are helping on improving their revenues, for example, you could develop a software which they will have to use and ensure that this is recurring revenue, and then upsell them with that, so you're monetizing even further your existing clients. Now, in terms of valuation, this was a very hyped stock back in COVID times. As you can see, in March 2021, it had a PE ratio of over 100 times. However, right now it's more reasonable, sitting at a 20 PE ratio with a free cash flow yield of 6.58%, which, when we compare it with the long-term inflation rate of 3%, is deemed as the company being at an attractive valuation. Now, any risks and possible challenges that I may see, the main one is the worsening of the competitive landscape. Since this is such a high growth and profitable industry, there are many competitors which are willing to enter the space and invest heavily in actually getting some market share. I believe that this company will have to continuously be innovating, continuously reinventing whatever kind of solution they're offering, and providing always best in class service to their customers to ensure that even though other competitors will be entering this space, their clients will remain loyal to them and they will retain that sort of recurring revenue and customer loyalty. Then, in terms of regulation and performance, I don't see any possible upcoming regulation changes, and I don't see this company not meeting performance objectives. However, I do believe that this sector is very affected by economic downturns and that it may have some cyclicality risks. This can be seen from the revenue in the past, and additionally, when you're a company and you're trying to improve your research and development or create new solutions and buy new software and new hardware, you usually do that when business is going either very well or when you are 100% sure that that improvement will help you reduce costs. And I believe that this kind of investment into these type of projects is more seen as something you do in an economic boom to benefit from the rising demand that your clients are asking for. So before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice. So please do your own due diligence, that this is a company with a very strong competitive advantage, which provides consistent and predictable cash flows and has higher return on capital employed. So I believe that this is a good company and a great investment, but it might be too cyclical for my liking. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.